Welcome to this video. In this video, we're going to discuss about capital deductions. Sometimes we call them capital allowances, or tax allowable depreciation. So in this video, we're going to look at how do we compute the tax allowable depreciation or the capital allowances, which is one of the major input when we are computing business profit. So capital deduction, by definition, those are form of standard depreciation which is given under the income tax law. So when it comes to tax capital deduction, we mean tax allowable depreciation which is allowed, or depreciation that is allowed for tax purpose. So this capital deduction can be in form of investment allowance or can be in form of what we call depreciation. So let's look at this, the accelerated depreciation, or sometimes we call it investment allowances. So these are given to registered investors. So that is a very key important part. They are given to a registered investor who invest in a new or business asset. So in this case, the investor must have invested in a new or business asset to be able to get this accelerated depreciation, or what we call investment allowance. So the allowance is calculated at 50% of the value of the asset. So you get the value of the asset, then you multiply by 50%, and then you get the investment allowance. So another important condition for investment allowance is that the investor must invest in asset, and the value of the asset must be at least $50,000 each. So this is a very key important part when you are to grant an investment allowance. So the value of the asset must be at least, meaning this is the minimum value that you can accept to give an investment allowance. So another important condition on investment allowance is the sector. So investment allowance, you must, to get an investment allowance, you must invest in sectors that are in priority sectors. And the priority sectors we have here, we have export projects, manufacturing, telecommunication, agro-processing, education, health, transport. But in transport, the vehicle must be 9 passengers and above. Tourism, the amount of investment must be at least 1.8 million US dollar if it is a tourism. Similar to construction, the value, if it is a construction, the value of investment must be at least 1.8. So in any sector, as long as the value of the investment is above 100,000 US dollar, then an investment allowance can be allowed. So another capital deduction is the wear and tear, or what we call the depreciation. We have already looked at this in our previous slide. So in this, we give you are not calculating the depreciation, or the normal calculation of the depreciation. So we get the cost, or the written down value of the asset. We add the new cost of the asset. You get the total cost. Then you get you less the fair amount, the amount on disposal. That's the sales price. You get the book value. Then apply your depreciation rate and get the depreciation of the asset. So this one we have already looked in our previous slides. So let's look at this example in order to be able to understand what the capital deductions are. So remember what I have said, in a capital deductions or in capital allowances, we are interested mainly in two items. we are interested in the investment allowance, or what we call the accelerated depreciation, and then the normal depreciation of the asset. So let's look at this example to be able to grasp what we have talked about. So we have this company, Madini Enterprise Limited, is registered under commercial law and received the RDP investment certificate. So this one tells us that this company is a registered investor. So by having an RDP investment certificate, is a registered investor. So the company has invested 1.8 million. So it has invested 800 million. So that's the amount of investment. The company is located in Ibrera district and deals in the mining of wolfram. This is the sector. So if you look at this sector, this company would not have been given investment allowance. But according to the amount invested, if you look at the amount invested, it makes this company to qualify. Because our last point we said, any amount that is 100,000 in any sector, that company can be given an investment allowance. So these are the assets we have purchased: heavy machine, trucks, computer and accessories, software, furniture, building. So I want to emphasize this one. In the London tax law, there is no separation of industrial building and non-industrial building. So if the asset is 150 million and it has got an office of 20, we consider the total value of the asset that was constructed. So we don't separate office building and industrial building in the tax law. So in 2017, the company purchased other assets. It purchased the machinery. It purchased two vehicles of 2-seaters each, meaning this one cannot be given investment allowance because it is 2-seaters, 4-seaters. Then we have extended building, which is 40 million. We have 2 computer software at 2 million each. Then in 2018, the 2 computers were sold at this, and the furniture was disposed at 4 million. So we are supposed to compute the capital allowances that will be allowed for tax purposes. So if you look at our information we're given, so we are starting with 2016. These are the values of the asset. This is the value of the building. This is the value of the plant and the machine. These are the value of the motor of computer and accessories. And this is the value of the other assets. We have combined motor vehicle and then furniture. So motor vehicle, remember there are 2 motor vehicles at 80 million each, meaning the total value of the motor vehicle is 160, then plus furniture 8.5, so we get 168 and 500. So our accelerated depreciation, or what we call investment allowance, it is 50%. So for this building, 50%, you get this. Plant and the machine, you get this. For computer and accessories, it is 0 because this value is below 50,000 US dollar. So because it is below 50,000 US dollar, then we don't calculate investment allowance on it. Now, if you come to other assets, remember we have 2 types of asset here. We have the motor vehicle and we have the furniture. Motor vehicle, there are 2 motor vehicles at 80 million each, which becomes 160. And we have furniture, which is 8.5, which is 80,500,000. So the furnitures here don't qualify, but the 2 motor vehicles, they qualify. So meaning here we are only calculating the investment allowance on the motor vehicles. So 50% of 160 of the value of the motor vehicles, then we get 80. So if you add this, we are getting 280 million. So this is the value of the accelerated depreciation that you should recognize in your profit and loss. Now, what I did not mention when we are starting this is that if a company has received an investment allowance, the investment allowance or the accelerated depreciation reduces the useful life of the asset or reduces the cost of the asset. So if an asset has received an investment allowance, then its depreciable value will be its original cost minus the investment allowance. So in this case, we are getting 150 minus 75 to get the depreciable value, or we get the cost value minus the investment allowance given, then we get the depreciable value. So on your depreciable value, then we can apply our depreciation So this is 5%, 5%, 50%, and 25%. So we can now get our depreciation, which is 46,125. This is the value that we are going to recognize in our profit and loss in 2016. So if you come to 2018, remember what I said. If you come to 2018, the assets which are depreciated on a straight line, you recognize the cost. Now, this is our new cost of the building because it received an investment allowance, and we said the investment allowance reduces the cost of the asset. So our new cost will be the 150 minus this. So we get this will be the new cost for the building, and this is going to be the new cost for motor vehicle. I mean for plant and machine. But when it comes to these other assets which we depreciate in a pool, we said you recognize the written down value. That is the net book value of the asset at the beginning of the year. So for computer and accessories, this is the net book value, and for other asset, this is the net book value. Then we recognize additional asset. So additional asset here, we have the building, which is 40 million, machine 85, two computers 2 million each, that is 4 million, and then two motor vehicles at 14 million each, we get 28. Now when you come to investment allowance, remember when we are calculating investment allowance, we calculate investment allowance on the new additional asset. We don't calculate on the previous asset. We only look at the new asset that have been added. So in this case, we are supposed only to look at the additional asset. Now if you look at this 40 million, 40 million is below the 50,000 US dollar. So therefore, we don't calculate investment allowance on it. When you come to machine, the machine is above. So we calculate investment allowance 50%. It comes to computer and accessories, this one is also below. We don't calculate. If you come to other assets, this one is also below 50,000. We don't calculate. So our allowance in 2017 will only be this, which will get a total of this. So then we look at the depreciable value. We are having the balance brought down, then plus the new asset. If you have given investment allowance, you less the investment allowance, then you get the depreciable value, and then we calculate depreciation at the rates that we know, and we get this as our depreciation for 2017. So for 2018, there is no additional asset. We recognize those assets. This one is recognizing the cost, that is the brought down plus the additional. Even this one, the brought down plus additional minus investment allowance. This one is brought down plus additional. We recognize the book value plus the additional asset, but we didn't have any additional asset. Even this one, we didn't have any additional asset. So what we have here, we raise the disposal. Remember we said we raise the disposal value, which is this. Then we get the depreciable value. Then on depreciable value, we calculate our depreciation. So meaning in 2018, this is the value of depreciation that you are going to recognize in your profit and loss. So this is what we can discuss as far as capital deductions is concerned. Remember we said as far as capital deduction is concerned, we are saying those are allowable depreciation for tax purpose, or depreciation that are allowed in income tax. And we said these depreciations or these allowances, we have the accelerated depreciation, or sometimes we call it investment allowance, and we have the normal wear and tear. So we have looked at the rules that need to guide us when we are calculating these capital deductions. I said that when you are calculating, the first thing you need to look at, the first condition, whether the taxpayer is a registered investor. If a taxpayer is not a registered investor, we don't calculate investment allowance, but we calculate depreciation. So you need to look at that. If he's not a registered investor, you only calculate depreciation. You don't calculate investment allowance. Another important thing, if he's a registered investor, then you need to look at the value of the asset purchased. Remember we said to get an investment allowance, the value of the asset must be 50,000 US dollar. So meaning that if the value of the asset is below 50,000 US dollar, even if you are a registered investor, you don't qualify to get an investment allowance. So you look at the value of the asset and see whether the value of that asset is 50,000 US dollar. Another important thing in investment allowance is the priority sectors, because we said the law provides the sector in which the investor must invest in order to qualify for investment allowance. So look at those sectors that we have mentioned and then see whether the business or the question you are attempting is showing the business or the sector in which the company is operating in. Then another thing we talked about is the wear and tear, which we have already talked up even in our previous discussion on business income. So then you need to know how to depreciate the asset, because we have some assets that are depreciated on straight line and we have some assets that are depreciated on cost. On reducing balance. So look at those assets. We said the asset of 5% and 10%, they are on cost. But the asset of 50% and the asset of 25%, you are depreciating on reducing balance. So the last thing that I can look at in summary of this is that if an asset has received an investment allowance, then the investment allowance reduces the cost of the asset. So when you are calculating depreciation, you first get the cost of the asset minus the investment allowance, then the value that remains is the one that you use to calculate your depreciation. So this is the end of this video, and please watch another video on corporate income tax.